Okay, so hi everyone and welcome back to BIA Basics. So this is a video series that we are doing to share our experience on how we will invest again as a beginner. So if you are new here, just to do a quick introduction, my name is Derek. I'm the founder of Better Investing Academy, and I've been investing for about 10 years or so already. And over the past 8 years, I have been guiding investors from many parts of the world how to build and manage their own portfolios. Okay, so that's a little bit of background about myself. Now, the thing is, if you're fairly new here, okay, you're joining this for the first time, I would highly recommend that you watch the first part one and part two of this video series because, well, if you're a new investor, then you probably want to know the basics, right? What do you do first before you start investing? So part one and part two will help you with that. And I already included the links to those videos in the description below. Now, today in part three, we will be discussing about how I pick my ETFs. So just to give you a little bit of context, on the stock market, you can buy individual shares, Amazon, Google, Meta, whatever individual shares. But you can also buy ETFs, which are ready-made portfolios. Okay, so when you buy a unit of ETFs such as the SPY, okay, this is a ticker. You buy one unit of SPY for $400 each. You're not buying a single stock. You're probably buying 500 companies for a single price. Okay, so that is the benefit of an ETF. Now, the thing is, in the last video, we talked about the importance of an ETF to me, okay, and why do I like them? Because as a new investor, right, it is not advisable or it is not really a good practice to put all your money in one stock because there's a saying that goes, if you put all your eggs in one basket, then if that stock don't do well, the whole basket breaks, the whole egg all gone, right? Yeah, so therefore we need to diversify. However, the challenge with diversification when I first started, I realized was, oh, to diversify, you need 10, 15, 20 different companies. The problem with that is there's a lot of decisions that I need to make. So for example, for a start, I need to find 10, 15, 20 different companies. So which company should I select? And then after that, what happens is that I need to decide what percentage do I need to allocate to each and every one of these companies, right? Some companies are stronger than another, so I need to allocate money differently. The stronger one get more. So which one is stronger, which one is weaker? This one also we need to think about. And then we need to think about, wow, so at what price should I buy? Is this a good price? Is it a bad price? So because of all these decisions, it makes the whole process very complicated. And which is why I like an ETF because it's a very cost-effective and also a very efficient way to diversify my portfolio. So if I start investing today again as a beginner, if I'm looking for the first stock to buy, I will always pick an ETF. Okay. And the way I use an ETF today is it will form the core of the portfolio. So as you can see from the picture over here, right, this cake, if you cut the cake, right, you'll see the cross section. In the middle, there's the sponge. So the ETF is like the sponge. It forms the shape of the cake. It forms the base of the cake, and makes it rigid so that it don't collapse. And what about individual stocks? Let's say I like Amazon, I like Google, whatever stock that I like, I add it on top of the ETF as a booster. Okay, so there's time I don't mind having my whole portfolio 100% in ETF as well. I don't mind it as well. Okay, so 100% ETF, maybe 5, 10, 20%, or maybe not 20, but 5, 10% in individual stocks. So that is how I structure my portfolio. Now, the thing is, the most popular ETF, right? Maybe some of you may argue with me about this, but in my opinion, the most popular ETF is the S&P 500 ETF. Any ETF that tracks the S&P 500. The S&P 500 is the top 500 companies in the US. Okay, so any ETF that tracks these 500 companies, these are the most popular ETFs, such as SPY, VOO, IVV. These are some of the tickers of the ETF that track those index. Okay, that S&P 500 index. Now, the thing is, one of the reasons why the S&P 500 index or the ETF that tracks them are very, very popular is because the S&P 500, right, has a very, very long track record. I think since the 1920s, about 100 years already also. Okay, very, very long track record. And at the same time, across all that time, right, across all those years, the annualized return is 10% plus per year. Okay, about 10% per year. In other words, for at least a century, the average return per year, right, is about 10%. Now, a lot of investors, when they look at that, wow, there's a lot of track record that they can trust. So that is why naturally, when someone thinks about investing in a fund, they will think about the S&P 500. Okay, yeah. However, S&P 500 may not be suitable for everyone. Some people will look at 10%, 10% is a little slow. Some people will look at it as, you know what, it's only in the US, I want to invest elsewhere, such as China, Hong Kong, or maybe Southeast Asia. I want to invest in other countries. Okay. Some people will look at it, S&P 500 can be a bit volatile. I want something with less volatility. So many investors have different needs, and therefore they might consider other ETFs other than the most popular one, which is the S&P 500. But if you want to stay with S&P 500, I think it's fine as well. Okay, at least for me. If I want to stay with S&P, I want to cut all the complexity, stick with the most popular, I would do that myself. Okay, so the thing is, how do we pick any other ETF? Because there are thousands of ETFs out there. So what other ETFs or exchange traded funds should we pick? Is there a factor or a criteria that for us to select? There is actually. So these are the factors that I personally use when I consider to pick my ETF, right? So the first one is historical track record. So any ETF that I'm going to pick, at least minimum, it needs a 10-year track record. 10 years. Okay. Yeah, the longer the better, of course, but minimum is 10 years. And of course, the track record, we want it to be positive. You don't want to you don't want a fund that is losing money over the past 10 years. Okay, then you got something else to invest in. Number two, the asset under management, AUM, we want it to be at least $1 billion. AUM stands for asset under management, as I mentioned. It basically means the size of the portfolio. Remember, exchange traded fund or ETF, you're buying a portfolio of stocks. So we want to make sure the size of the portfolio is at least 1 billion. Then you'll be asking, why 1 billion? Anything special after 1 billion? Well, the reason why is because of the expense ratio. So the expense ratio basically tells us how many percent of the AUM that the fund manager takes as their fee. You see, the fund manager is also a company. A company, there's a business, they need to earn money, right? So because of that, they will take a percentage of the fund value every single year. They'll take a percentage of it as their fee. Okay, so that fee is known as the expense ratio. If the AUM is too small, then what's going to happen is the business won't be profitable. The fund manager won't make money. So if the fund manager doesn't make money, they will quit the business. Then I need to look for another ETF. So that is not good. Okay, so we want an ETF with AUM more than 1 billion so that the fund manager can make enough money and stay in the game for the long term. And then the expense ratio or the fee that they take, we want it to be less than 1%. In fact, a lot lesser than 1%. Okay, I only put 1% as a benchmark because most unit trusts, mutual funds, actively managed funds, okay, they have they have expense ratio of fees above 1%. Okay, so for ETFs, right, they are mostly passively managed funds. Passively managed means they have a fixed set of rules, and they just follow these rules to select the stock. Don't need too much thinking. So because of that, right, the expense ratio are normally low. But mutual fund and unit trust, the fund manager, they think a lot, they discuss a lot to choose the stock. They do more work, so normally they demand more fee. But for ETF, we prefer lower fees. Lower fees, passive management doesn't mean worse returns, as you will see later. Okay. So number 4, we want to know who are the ETF issuer. In other words, who is the company running the show? Okay, who is the company that's managing all these funds? And the ETF issuer, we are looking for someone who is reputable and has a lot of experience running this business itself. Later, you'll see the list that I'll share. Okay. And then number 5, which is the most important one, the ETF team and portfolio. So remember I told you that an ETF is passively managed by a fund manager. So they have a set of rules that they use to select the stocks that goes into the fund. I want to know what these rules are. Okay, the rules are basically the theme. Okay, I want to know what are the current top 10 companies in the ETF. And I'm also looking for any portfolio concentration. Are they overly concentrated in a few individual stocks? Okay, so I want to try to avoid that as well. All right, so now these are the 5 factors to consider. And the next slide over here, I want to show you the reputable ETF issuers. So these are some of the famous names, okay, for companies that manages ETF. Of course, there's more than 10. These are the top 10 that I've selected. I will put in the link to this table in the video description as well. So as you can see here, revenue rank, the company that makes the most money from ETFs is BlackRock. Okay, the number 1, they make about $4 billion from ETF fees itself. The number of ETF they manage is about 439. That shows that they really know what they're doing. And the State Street, Invesco, Vanguard, so on and so forth. So normally I will pick within this top 10. Okay, yeah, I will make sure my ETF issuer is within this top 10. So now the next question is, okay, there is so many ETFs out there, thousands and thousands. I know you have a list, but where do I start? So for that, we have two important tools or helpful tools that we use, okay, to find the ETF that we want to invest in for the long haul. So the first one is ETF Research Center. This is the website that we use to screen for ETFs, okay? And the second one is ETF.com. So this is the website that we use to analyze ETFs, okay? I will include the link to these two websites in the video description as well. Now, I'm going to go to this two websites that you can see on my screen here. So this is ETF Research Center, and this is ETF. The second one is ETF.com. Okay, yeah. So now what we're going to do is we're going to follow this list. Yeah, we're going to follow this list when we are selecting the ETFs. So remember, this ETF Research Center is where we screen or search for ETFs, right? So how do you use it? Very simple. There is ETF Finder over here. Very obvious, right? So you click on ETF Finder. Now, of course, they will ask you, I mean, very simple questions such as domicile. So where is the ETF listed in, US or Canada? Okay, so most of the time you want to choose US ETF. It's the largest market for ETF. Okay, so the US. So asset class equity, leave it here because we want the ETF to have stocks. But if you're interested, you can find other stuff as well. But if you're very new, just stick with equities. Equities meaning stocks. Then of course, category. What equities do you want? US equities, meaning you want only US companies, or you want international. International means outside of the US. Emerging markets, which means, well, emerging markets, Southeast Asia, for example, or you want global. Global means everywhere around the world. Okay, so let's say for me, I want to stick with US equities, only US. So I will search show ETFs. Then I wait for a while. Okay, wait for this to populate. And here we go. So what you might want to do, right, is to edit the columns because they have a lot of not so useful information here. So you might want to go to columns and you might want to close a few stuff. So for example, I don't need expense, I don't need volume, okay, and then analyze performance, I will go for 10 years, okay. Now, why don't you go since inception? I mean, in other words, why not see the return since the first day the fund started? I wouldn't do that because that way, I will not know how long the fund has been operating. Because if I put inception, if the fund has only been operating for 3 years, then it shows inception only the past 3 years. So there is not enough track record. So for me, I want at least 10 years. Okay. So once I have this, then I will, actually, once you click on this, right, they will already populate for you, as you can see here. Okay. So let me just close this. Now, what a lot of people like to do, right, is they like to filter this. So they filter. Okay, and they normally go for the highest return. Very classic human behavior. They like to go for the highest. So normally when they go for the highest, they see, oh, USD, this is the ticker, the stock ticker, USD. The returns over the past 10 years is 44%. So every year on average is 44%. That's fantastic growth, man. You know, very fantastic growth. And the asset under management is 1,000 million, which is 1 billion. Okay, so it's still above 1 billion. Pretty good. So people will get interested. Now, if let's say I'm interested in this particular ETF, what would I do? I will remember the stock ticker. I will go to ETF.com. This is where we do further research. Okay. So I go to ETF.com and I'll search for USD. Enter. And ta-da. Okay, so we have there the first one, USD. ProShares Ultra Semiconductor. So just click on it, take a look. Okay, so we follow the 5 criteria that we have here. Historical track record, AUM, expense ratio, ETF issuer, so on and so forth. Okay, so we start with performance since we all know the historical track record, right? Performance, and we scroll down. Okay, you can actually see the chart as well. Just click on max. Then you get to see how have they been performing. So you see, you know, since 2007 they started, but last time they weren't doing so well. Suddenly they explode since 2022 onwards, they start to explode. So most of the returns are generated only in the last few years. So this should raise some suspicions really, actually. Okay. And then, right, if you look at the performance, past 10 years is 44%, which is fantastic. But you see in 1 month, you can lose 23%. You see. So what does this mean? Okay, this means that although this ETF has been performing very, very well, however, it is also extremely volatile. Extremely volatile. You can lose 20% in 1 month. Are you comfortable with your portfolio dropping 20% in value in 1 month? If not, don't touch. Okay. So of course, the next one, we're going to take a look at AUM. So to do that, we go to overview. Okay, so we see AUM, where is it? Here. 1.22 billion. Okay, fantastic. Next, expense ratio. And you can see an expense ratio, 0.95. It's touching 1% already. So that's a pretty high expense ratio. Okay. Then of course, we want to know who is the issuer. So the issuer is ProShares Advisors. Okay, so I go to ProShares Advisors. Is it here? ProShare Advisors is in the top 10. Okay, managing 146 different ETF. So again, I'm comfortable with this issuer. Now, what does the fund do? Which is criteria number 5, right? What's the theme? Now, when you go to that criteria, you're going to see the theme of the ETF. Normally, it's here under overview. So analysis and insights. So when you go over here, it shows that USD, which is the ticker itself, provides 2 times exposure to a market cap weighted index that tracks the performance of large US semiconductor companies. So what does this mean? This means that this particular ETF, all right, what it is a leverage product. Leverage product means they don't hold really individual shares. Instead, what they hold is a set of derivative. Derivative means they use financial instruments to try to make it so that the returns that they generate is 2 times the semiconductor industry, 2 times the top, 2 times the performance of large US semicon companies. So they don't really hold individual shares. They hold financial instruments such as options, futures, whatever they hold. Okay, swap sometimes, and they try to double the returns. Now, this kind of ETF, they are not buy and hold ETF. They are more like trading tools. They are tools for investors who love to trade. Okay, they like to trade the momentum up and down. This is for them. But for investors like us, whereby we want something that we can hold long-term, consistently deploy money to form the core of the portfolio, these are one of those products that I will avoid. So you will see that they even mention in their description, USD is a levered product. Okay, it is not a buy and hold ETF. It is a short-term tactical instrument. Okay, so when I see something like this, I avoid straight away. Okay, don't need to go on further. Then of course we can do more checking. Let's say this time, okay, by the way, I just want to show you here as well. If you see 3x like this, right? 3x, you see a number and x. Normally these are leverage products already. Or you see Ultra Pro, Ultra, you see the word Ultra, right? Yeah, so the word Ultra, 3x, 2x, these are normally leverage products. You can avoid them. Okay, yeah, so I would avoid them, sorry. Now, here's the thing, IYW. Let's say we take a look at this. Okay, or maybe you take a look at this one, higher return. Oh, roughly the same. This one more asset. AUM is higher. So we look at XLK. Now, what I will do is I will go over to XLK. All right, XLK. Okay, then I'll search for this. Okay, XLK. All right, so we go through the 5 steps as usual. Historical track record. So let's take a look at performance. Wow, over the past 10 years, average return per year is 20%. Fantastic. No problem here. I mean, like 20% per year on average is very good to me. Okay, so the next one is I want to take a look at AUM, right? So the AUM is $69 billion, 69 times the minimum. I think it's good. The expense ratio is only 0.09%. Very, very low. Okay. This one, I'm also good. Who is the issuer? Issuer is State Street. So State Street, is it in the top 10? Let's take a look. State Street is the second, right? Second, in terms of revenue generated, $1.4 billion a year. And then they manage 136 ETF. That's fine for me. Okay, no problem. So, no issues over here. And the last one is the ETF team and portfolio. So the ETF team is in overview. Just scroll down. So what they plan to do, or what does the fund do? It tracks an index of S&P 500 technology stocks, which means they go through the S&P 500, these top 500 companies, and they select technology stocks. Okay. So when you go into the holdings, right, what they hold, you can see they hold number of holdings, 69 companies, means they hold only 69 companies in the portfolio, all right? And then if you look at the weightage, 65% of the money is in the top 10. And 34% of their money is in all the other stocks. So the other 59 different companies. Okay. So there's a lot of concentration on the top 10, like 2/3 of the money is on the top 10. And when you see how they allocate, right? 22% is in Microsoft, 20% is in Nvidia. The rest get 4%. So you can see it's like heavily biased, very, very biased towards only a few companies. Okay. And because of this, right, there is a concentration risk for me. Concentration risk meaning that if anything should happen to these two companies, then the whole portfolio will be impacted. Now, the reason why I go for an ETF is because I'm trying to avoid concentration. And if there's concentration like this in the ETF, me buying this ETF basically, doesn't follow that rule, right? I'm trying to avoid concentration. I want to diversify, but buying this ETF defeats that purpose. So this is one of those ETF whereby once I see, I will avoid. Okay, yeah. So of course, this is not the only way that you can find ETF. For example, you don't always have to use ETF Research Center. Sometimes you can also look for it over here. So for example, I want to look for China. Well, some people say, well, I think China is coming up soon in the future. I want to invest in Chinese ETF. What can I do? So you can go over to the search button here and you can search for China. Okay, just search for China. And then it will bring up some results like this. China ETF list. So just click on this. And then you should be able to see a list of Chinese ETF. There's 43 of them. Okay, so there is MS here. You can even see the issuer, this is BlackRock, Invesco. You can see like, Invesco, Invesco is the third largest. Okay, so you get to see who is the issuer. You get to see the AUM. You get to see the expense ratio. So for example, like this one failed already, 1.47%, AUM too small. Just avoid. Okay. Yeah. And then leverage some more. So this one also I avoid. Then from here, you get to see the segment. So this is equity, total equity China. So they buy all the Chinese stocks. Okay. This one is Chinese internet. Okay. Chinese large cap. Yeah. So you get to search for all the Chinese ETFs here as well. Okay. Now let's say you want others, you can also search here. You want semiconductors, you want technology, you can also use this search. So this is another way you can search for your ETF. Now the way you find the ETF that you want, right? At least the way I did it is I go through a lot of these ETF. If you ask me, I go through 111, the answer is no, because normally I have a cut-off return. So for me, anything below, like, because I know the S&P 500 is 10% per year, right? I'm looking for anything above 10% per year. Anything below 10%, I'll just avoid. So I look for something like 12, 13, 14, 15, higher the better. Okay, then I go through all these returns, right? Like I go through page 1, page 2, page 3. You start to see the returns dropping off. Okay, very quickly. By page 5, you roughly know what ETF you want already. Okay, by page 10, sorry. So by page 10, I see 11%, most of it. I won't bother. If I'm going to go for 11%, I might as well go for S&P 500. Roughly same returns. Okay, yeah. So 12% average return. By around here, I should know what ETF that I want. Okay, so when I went through all of this, one of the ETF that I personally picked for my own portfolio is XLG. Okay, yeah, so XLG. Last time I used to pick triple Q, but I move on to XLG. Okay, not because triple Q is worse, I just prefer XLG. Okay, so XLG, this one is the top 50 ETF. Okay, so this ETF basically tracks. Okay, this one don't bother. This one there's a stock split. Basically, for every one share, I think is split. For every one share you will split to 10 shares. So that is why the price just drop a lot. So don't bother about this. But this ETF, right, tracks the top 50 companies in the S&P 500. Okay, 50 largest companies in the US, basically. All right. So this to me is fine. All right. Then as usual, asset under management, more than 1 billion, 5 billion, I think is fine. Expense ratio is very low. Okay. The issuer is Invesco. So Invesco is the third largest. Again, I'm fine with this. Okay. Yeah. Then of course we see the performance is about 14 to 15% per year over the past 10 years on average. Okay. I think I'm fine with this as well. Past 5 years, about 18%. No issues. Holdings, what they hold? Well, they hold 53 companies. Okay, which to me is enough. And then in terms of the weightage, 60% of the money is in the top 10. The others, 40% is in the other 40 different companies. Okay, it's relatively okay for me. And when you look at the allocation, it's roughly balanced. Yeah, it's not like just now XLK, only two stock, 20%, the rest like 4, 3%. This one is like somewhat balanced, more balanced than the other. So because of this, I'm fairly comfortable with this particular ETF. Okay, yeah. So this is basically the method I went through, from the first page until by around page 11 or so. I roughly know what ETF that I want already. But if let's say you want to cut short the time, right? Okay, so what I will do here is I will show you the list of ETF because I went through that list, right? I will show you the ETF that I personally like. Okay, whether you like them or not, I highly suggest that you go through the same process, see which ETF suits your taste. But for me, these are the ETF that I like. So the first one is any ETF that track the S&P 500 because, well, track record is very good. So such as SPY, SPLG, CSVX, VOO, IBV, etc. So these are all the ETF that track the S&P 500. Second one is the triple Q. So triple Q tracks the top 100 shares on the NASDAQ. So this one only tracks one exchange in the US. In the US, there are many stock exchanges. There's NASDAQ, New York Stock Exchange, Philadelphia, a few exchanges on the US. The largest, of course, is the New York Stock Exchange and the NASDAQ second. But triple Q only tracks the NASDAQ. So last time I used to hold triple Q, but then I decided, okay, you know what? Maybe I'm missing out on some good companies on the New York Stock Exchange. So that is why I switched from triple Q to XLG. Okay, because XLD tracks the top 50 companies in the US. And then, of course, the third one is SOXX. This tracks the top 30 semiconductor in the US market itself. Sorry, US listed semiconductor companies. And therefore, for me, I believe that semiconductor is the future. Okay, I don't see a way whereby we go without semiconductors. In fact, as technology progresses, semiconductor is a necessity. In fact, right now it's even a geopolitical it's in the center of a geopolitical storm. Okay, it's a geopolitical issue. So that shows how important semiconductors are. Okay, so one thing to take note is SOXX, right? Semiconductor industry is very, very cyclical. So there's good cycle, there's bad cycle. So if you're going to retire, and if I'm going to retire anytime soon, right, myself, I will avoid this kind of ETF. However, if let's say I just started my career and I have a very long time ahead of me, then I can take the volatility. So that's how I think about it. Okay, XLG is just, well, the top 50 shares on the S&P 500. Personally, it's like another version of triple Q. It's just a more concentrated version of the S&P 500. So for me, I'm also comfortable with it. But these are the ETF that I like. Okay, yeah, these are the ETF that I like that you can take a look at it, right? Or you can search for the ETFs that you like as well. Okay, you can use the method that I mentioned earlier, the one that I use. So that, in a nutshell, is everything that I want to share in this video itself. Okay, so if you find this helpful, do consider following and subscribing to our channel. Otherwise, I look forward to share more with you in the future series. Okay, so that's all for now. See you guys again very soon. Bye-bye.